What's happening in 2026 is worse than 2008 on several key metrics. Buyer demand is cratered to the lowest level ever recorded. January's pending home sales data came in at 70.9, the lowest reading in the entire history of that index. Going back to 2010, the NAR's own chief economist is now calling this a new housing crisis. The Fed has already cut rates 6 times, 175 basis points worth of cuts, and has done absolutely nothing to bring buyers back. Here's what we need to break down. How many homeowners are now underwater, and which cities are getting hit hardest? Why the Northeast and Midwest, markets everyone considers safe, maybe the next domino to fall, and exactly what Phase 2 means and why it's fundamentally different from everything we've experienced over the past 3 years. According to the National Association of Realtors, existing home sales in January 2026 fell to a seasonally adjusted annual rate of 3.91 million units, down 8.4% from December, the sharpest monthly drop in nearly 4 years. At the peak in 2021, we were doing 6.73 million annualized sales. That's a 42% decline from peak demand. What makes this different from previous downturns is its duration. We are now in year 4 of record low buyer demand. Even in 2008, the downturn was sharper but briefer. This is a slow grind that keeps getting worse. The forward-looking data is even more concerning. Pending home sales, measuring signed contracts, just hit 70.9, which is 20% below where we were in January 2011, in the middle of the housing crisis aftermath. Think about that. Worse forward-looking demand right now than during the Great Recession recovery. Homes are sitting on the market for 62 to 66 days in January 2026, compared to 36 days in January 2022. As of September 2025, 70% of all U.S. listings have been sitting for 60 or more days without going under contract. In Miami, that figure is 84.6%. In Austin, 82.8%. When more than 8 out of 10 listings can't find a buyer after 2 months, the market is in serious trouble. Why is demand this low? Because affordability is completely broken, and nothing the Fed has done has fixed it. The national median existing home price in January 2026 was $396,800, a record for the month of January. Home prices are now 5 times median household income nationally, according to the NAB. The historical norm was 3.2 times income. At the 2006 bubble peak, we were at 5.5 to 7 times. We're right back in that danger zone. The typical monthly mortgage payment, including taxes and insurance, runs between $2,559 and $2,768, depending on whose data you use. According to Redfin, the income needed to afford the median home is $111,252 per year. The actual median household income is about $83,150. That's a gap of nearly $28,000. The typical American family literally cannot qualify for the typical American home. First-time buyers have been effectively shut out. Their share of purchases dropped to a record low of 21%, down from a historical norm of 40%. The median age of a first-time buyer just hit an all-time high of 40 years old. All cash purchases reached an all-time high of 26% of all sales. The only people buying right now are people who don't need a mortgage. The Federal Reserve has cut rates 6 times since September 2024, bringing the federal funds rate from 5.5% down to 3.75%, 175 basis points cuts. The 30-year mortgage rate has barely moved. It was around 6.5% when cuts started. Today it sits at 6.01% per Freddie Mac. After the first 3 cuts, rates actually rose and surpassed 7% in January 2025. JP Morgan now says it doesn't expect any further cuts in 2026. The Fannie Mae Home Purchase Sentiment Index fell to 71.6 in February, its first year-over-year decline in 2 years. 78% of consumers say it's a bad time to buy. Builder sentiment sank to 36, the 22nd consecutive month below 50. The Fed is not going to save this housing market. The problem isn't rates. The problem is prices are too high. According to February 2026 IC Mortgage Monitor, 1.1 million borrowers ended 2025 underwater on their mortgage, the highest since early 2018, representing 2.1% of all mortgages. At the start of 2025, there were 696,000 underwater borrowers. In 1 year, that number jumped 58%. An additional 3.2 million borrowers have less than 10% equity, a very thin cushion. If prices drop another 5 to 10% in their markets, millions more go underwater. Over 90% of currently underwater homeowners bought between 2022 and 2025, at or near the peak. Total borrower equity declined by $373.8 billion, with the average homeowner losing $13,400 in a single year. Here's where the pain is most concentrated. Lakeland, Florida, 10.8% of borrowers underwater. Cape Coral, 10.1%, with values down 13% from peak. Austin, 9.2% underwater, now 27.8% below its 2022 peak. San Antonio, 8.8%. Tampa, 5.4%. Colorado Springs, 5.6%. Some will note that the negative equity rate is still far below 2008, when 23 to 26% of homeowners, roughly 11.1 million, were underwater compared to today's 1.1 million. That's true, but in 2005 and 2006, before the crash accelerated, the numbers were low too. It always starts as a drip in specific markets and specific loan vintages. Then it spreads. We are clearly in the early innings of that pattern. 1/3 of U.S. housing markets are now declining. 100 of the 300 largest metros are posting year-over-year price drops. The worst, Northport, Sarasota, Florida, down 8.6 to 8.9%. Austin down 5 to 6.3%. Tampa down 3.6 to 3.9%, with 13 consecutive months of annual declines. Phoenix down 2.2%, with nearly 87% of homes losing value. Denver down about 2%, with 91% of homes losing value. Florida's condo market is in full-blown crisis. The median condo price dropped 8.1% year over year, the biggest decline since 2010, while inventory exploded 35 to 37%. Post-Surfside legislation requires structural inspections for buildings 30 years or older, affecting 900,000 of Florida's 1.5 million condo units. Special assessments of $20,000 to $50,000 per unit are becoming common, and over 1,400 condo associations are on Fannie Mae's financing blacklist. The inventory numbers tell the broader story. Florida has 202,157 homes for sale, 42% above 2019 levels with 8 months of supply. Texas has 151,769 homes, 48% above 2019 levels with 7 months of supply. Sellers are capitulating. 34.2% of listings nationally have taken price cuts. The typical buyer paying below asking is getting a 7.9% discount, the largest since 2012. 62% of all buyers are paying less than list price. Meanwhile, sellers unwilling to cut are simply delisting. Withdrawn listings surged 28% year over year. In Miami, there were 59 withdrawn listings for every 100 new listings. According to Redfin, there are now 37.2% more sellers than buyers, the largest gap in their records going back to 2013. The Sunbelt correction is well documented, but the markets that everyone considers safe right now, the Northeast and Midwest, are showing warning signs of their own. On the surface, they look strong. Chicago led the Case-Shiller Index at plus 5.7%. New York is up 5%. Hartford. Connecticut was named the #1 hottest market for 2026. The reason is simple. Inventory there remains 40 to 60% below 2019 levels. But here's the concern. These markets are becoming increasingly overvalued while simultaneously losing population. New York lost 137,000 net domestic migrants in 2025. New Jersey and Massachusetts are still losing people. Illinois lost 40,000. Prices are rising in markets that are shrinking. A crash tomorrow? Unlikely. Inventory is too tight for that. But buying into a significantly overvalued market that's losing population over a 12 to 18-month horizon carries real risk. Consider the contrast. Austin is 27.8% below its 2022 peak, while Hartford is 21.2% above its 2022 peak. Those trends will eventually converge. Phase 1 was a freeze, what we experienced from 2023 through most of 2025. Buyers stopped buying, but sellers also stopped selling. Transaction volume collapsed while prices stayed elevated because there was no inventory. Sellers could wait because they were locked into 3% mortgage rates. It was a standoff. Phase 2 is fundamentally different. Phase 2 is when sellers are forced to act, and several forces are converging to create that pressure. First, the lock-in effect is fading. The share of mortgages above 6% now exceeds the share below 3%. Owners who bought between 2022 and 2025 are paying 35 to 40% of their income on housing. When life events happen, they cannot afford to sit. They have to sell. Second, negative equity is spreading. With 1.1 million borrowers already underwater and 3.2 million with less than 10% equity, as these homeowners sell at losses or go to foreclosure, it adds inventory, pushes prices down further, and puts more people underwater. Third, a wall of debt is coming due. Over $930 billion in commercial real estate loans mature in 2026. 60% of the most distressed apartment loans come due in the second half of 2026. Forced sales are coming to that sector as well. Fourth, and this one is underappreciated, the migration engine that powered Sunbelt housing demand has completely stalled. Florida went from 310,000 net domestic movers in 2022 to just 22,000 in 2025. That is a 93% collapse. Alabama now has higher net domestic migration than Florida. Texas fell 70%, from 222,000 down to 67,000. On top of that, the Census Bureau reported that net international migration to the U.S. dropped 54% and is projected to fall further. These Sunbelt markets built enormous amounts of housing during the boom, priced it at elevated levels, and the flow of people moving in has dried up. Without people, you cannot sustain those prices. Fifth, foreclosures are accelerating. Filings were up 14% nationally in 2025. FHA delinquency hit 11.52%, the highest since 2021. FHA loans account for 52% of all seriously delinquent mortgages and 80% of the rise in foreclosures. Treasury Secretary Bessent himself has stated that the housing market is in a recession. Phase 2 is a shift from a frozen market to a forced selling market. The drip of price cuts is turning into a stream of foreclosures, short sales, and desperate reductions. The data is clear, but not every market in America is crashing. Hartford, Rochester, and Chicago remain supply constrained. If you're in Florida, Texas, Arizona, or Colorado, however, you need to understand what's happening. Prices are dropping. Negative equity is rising. Foreclosures are accelerating. And 6 rate cuts have done nothing. Understand the data in your specific market before making a move. The decisions made in the next 12 months could save or cost tens of thousands of dollars. This is not the time to guess. This is the time to know your numbers.